we are going to take a look at a 45-year-old individual looking to accomplish several of his goals. He's got his entire plan mapped out as far as where he wants to be in the next 20 years. And cash value life insurance is a great fit, can help him accomplish exactly what he is looking to do. So we're going to go through that. Now, he had a lot of questions here. So you might be in this situation where you're interested or intrigued by the idea of cash value life insurance. Perhaps it's the banking concept, retirement income, whatever it might be, but you've got questions. Maybe you've been presented a policy or you've heard about it and you're looking at it and saying, okay, I'm putting this money in and A, I don't see enough money in cash value, or B, I'm told I can borrow, but hey, it looks like the interest rate I'm paying when I take a loan is greater than what I'm earning. I've got questions. I want to understand it in and out to really make an educated decision to see if it is a fit for me or not, or used in a different way than what I had originally believed it to be. So we're going to get into this individual situation and answer a lot of questions that a lot of people often have. So what he wants to do in terms of funding the policy is he wants the ability, key word there, ability to fund up to $100,000 per year, but he does not want to get a bill for $100,000 per year. So many people are not aware of the fact that we can design a policy. Any agent can, really, depends on the insurance carrier or companies we're using, but a policy can be designed where one has the ability to pay up to $100,000 or any dollar amount, but commit to a minimal amount. So I could literally take a case like this and commit to very, very close to $10,000 per year, and then have the ability to add up to $100,000 per year, but it's completely in my control whether I hit that or not. I am not billed for it. The neat part about that is I'm shifting a life insurance policy, which is typically an insurance policy, pay a premium, pay a premium, pay a premium. If I die, a death benefit's paid out, and turning it into a flexible savings asset and using it like a lot of these wealthy individuals and corporations do that are so laser focused on the cash value accumulation. Funding period. So he does not want to have to pay into the policy forever or for a long period of time. Very attracted to the idea of funding for a short period of time, 5 years, and then saying, hey, I'm done. But does state, hey, I might want the ability, or the option, I should state, to fund for 15 years, which I'm 45 now. That would take me up until age 60. So show me both, and perhaps some other options as well. I want to be certain when I work with you guys, Steve, and go through your process, I'm also talking to other individuals, that everything is set up where I can use the product to the fullest degree and I'm aware of the pros and cons. Don't just show me the benefits here, show me the pros and cons. We're going to do that as we go through this. Primary goal with the cash value. So with the life insurance policy, he is cash value driven. That's his number one objection. The death benefit is important. You're going to see that when we touch on his personal goals here. But cash value, the safety, liquidity, and access to his capital is most important. A unique feature to accessing money in a cash value life insurance policy, this is specifically with loans, is that once a dollar passes through a policy, let's pretend it's earning 4 or 5%. If I borrow money out, I will continue to earn that same 4 to 5% on the remaining money in cash value that I have not borrowed out and the money that I have borrowed out. Works very similar to a piece of real estate that continues to appreciate over time. We're going to look at an example and really focus in on exactly how that works. The interest paid to the policy, the interest paid to the insurance company if I have a loan outstanding, so we can see everything there. Now, some personal primary goals here is 1, he wants to help and mentor others, which is a great goal in my opinion, which has not a whole lot to do with money, but from a business standpoint, when you're helping others, with personal development, business development, getting ideas from another individual, that makes everything else flow from a business and income standpoint. That, the most value is there, in my opinion. I love that. Helping others, putting others first before yourself will help accelerate everything, really in anyone's life. That's the most important thing. With his business, he wants to grow it over time. And specifically, wants to utilize policy loans. So grow the business. Here is an area, the cash value life insurance product, to store cash capital that is accessible that right now in his bank doesn't do much for him. So it's a way he can actually see a return on his money and be able to utilize it for opportunities as they arise. Build wealth really in a safe manner, safe, liquid area to position funds. A cash value life insurance product, if it is with one of the major mutual companies like a Mass Mutual, Guardian, New York Life, Northwestern Mutual, we've consistently seen them deliver strong actual internal rates of return on cash value. Not just projections, but actual policies that have lived the test of time. When they're properly designed with the ultra low dividend interest rate environment right now, and the likelihood that it may remain low for a little while, maybe another 5 to 10 years, I'd realistically set expectations as far as, hey, what can I expect this policy to grow to? If it's designed properly, somewhere in the 3.5 to 5.5% net IRR over time. IRR stands for internal rate of return, the tax-free net growth, we could call it. Tax-free if we do everything right. And then leave a legacy. So the death benefit is important. Death benefit proceeds are a great way to leave a legacy because the death benefit is always paid income tax-free. It is not exempt from my estate, so it's not estate tax-free unless I unless I have it structured in the proper type of trust, which I want to work with an attorney or a professional in that area. So we discussed the policy design. This is a very important area. So we're going to get into that in detail here and then look at some actual numbers because that's very important. Seeing options and policies up front. So here we've got funding 5 to 15 years. Seeing options, let me clarify here exactly what he wants to see. Guarantees. Don't just show me the best case scenario. Different companies. Then also different products. So wants to see different companies, different products, loan options, paying the loan back, a lot of stuff up front, which is perfectly fine. I mean, a consumer, whether you're putting in $5,000 per year or $500,000 per year, whatever that dollar amount is, should never feel like they're asking too much from an agent. Like, this is your money going into a product. We should understand it or have someone that's willing to help us understand it over time. So let's take a look here. We're going to look at the policy design, but the two carriers he considered here are as follows. Two of the big four major mutuals, Mass Mutual and Guardian. Okay, key features that we want to look at here. Performance, premium and PUA limits, flexibility as far as how he can actually add money to the policy. Recognition, specifically that has to do with direct and non-direct recognition, present dividend rates and loan rates. So let's look at this guy here, policy design. And this will complement the premium and PUA limits as well. So with both Mass Mutual and Guardian, and really all insurance carriers, this is one of the most important pieces to be aware of. If I'm paying any amount of money into a product, in this example, he's looking at $100,000 per year. If I'm you, if we flip positions, I want to know where is my money going because it can go toward premium or toward the PUA component. So understanding the relationship to these two areas is critical. So let's assume we have $10,000 per year going towards the premium component of a life insurance policy. How will those premium dollars function in your policy? What will you see in cash value? What do you see in death benefit? The premium dollars. In respect to your cash value in the first year, and sometimes the first and second year, depends on the company and product selection here, I will see little to nothing show up in cash value. The reason why is that premium purchases me a death benefit initially. With a whole life insurance product, the company is in a sense overcharging me for the death benefit up front. Why I state that is as time passes and we look at the third year from that point forward, you will begin to see that $10,000 payment show up in cash value. That's money I can access and begins to earn the guaranteed rate plus any dividends. So it does build equity or cash value over time. It is not just a premium like a premium we would think of on an auto insurance policy, a term life insurance policy, or any other insurance product that I just pay for a benefit, and if something bad happens, an insurance claim is paid out. Not quite the same with a cash value life insurance product. The premium dollars will build equity over time. Now, as we continue on here, PUA dollars. Let's assume I'm going to pay the same $10,000 per year into the PUA component. What you will find is in respect to your cash value, we'll see approximately $10,000 show up in cash value right off the bat. This is money I can access. This is money that begins to yield the guaranteed rate. This is money that begins to yield dividends. The access piece is very attractive to many individuals. Now, the term PUA rider stands for paid up additions, and what that means, how it actually functions in the life insurance policy specifically, is if I make that payment, a PUA payment, I see it show up in cash value, probably be about 97, 98% immediately, but then paid up additions. That payment purchases me what is called paid up additional life insurance or death benefit. Why it is paid up is that this is optional. Have you ever seen a whole life insurance product where the product name was Life 100, where you've seen in the contract language that premiums are payable until age 100? That is not the case with the PUA component, as that can be paid if the client chooses to do so, or if he chooses not to do so. The amount can be adjusted. You can also shut that premium down way before age 100. You're going to see that exactly in the example soon. Point here, though, is this is optional. So a question we often receive here is, okay, Steve, thanks for going through that. I don't care about the death benefit. So how do I put 0% of my $100,000 in the premium and 100% of my payment towards the PUA rider? That would function a lot like a BOLI product, a bank-owned life insurance product. We cannot go quite that aggressive, and the reason why has to do with limitations. So, limits we need to be aware of. We have the insurance company limitations and then the IRS limitations. If we were to focus on some of the major mutual carriers, like a Mass or a Guardian, we're going to look at in this example, and a lot of other carriers, you will typically see that you could drive that premium down to 10%. Some smaller companies do let you go lower, but typically with the bigger guys, we've seen them allow us to go about as low as 10%. Sometimes you can push it a little bit lower to about 9% or so, based off their contract language and other limitations they strictly enforce, and then enforce very softly. Important to be aware of that, though, especially if they can change anything. So if I have 10% going towards the premium, I'd have a term rider in there as well. That might be another 1 to 2%. But then everything else I can pay into PUAs. So going to this example, where the individual wants the ability to make a total payment of $100,000 per year, he can commit to that minimum premium of $10,000 and has the ability to go up to 100. That's another $90,000 into PUAs. This minimizes the insurance expenses as low as we can push them based on the insurance company limits. So I want to know, okay, with each specific company I'm looking at, how low can I drive that premium, which reduces the expenses, reduces the initial hit on cash value. If you're an agent, it does reduce compensation upfront and long-term because the base premium is the main driver of compensation. It reduces the cash value hit. That's the area of attraction. What it enhances, or I should say, what it gives us the ability to do is add more of our cash flow towards the PUA component, which allows us to what? Enhance the cash value. And if you're an agent, commissions are paid on PUAs as well. They're very small, but snowball effect. It will add up over time. Just stay focused, continue to do the right thing. So that is the insurance company limitations. And then we have the IRS limitations, which has to do with this guy. So core benefits to a cash value life insurance product, if I do everything properly: safe, liquid, tax-free. Tax-free if I do everything properly. Here's where I'm going with this. Any life insurance policy can become classified as a MEC, which stands for Modified Endowment Contract. If it does, the cash value still grows tax deferred. However, if I access my money, any of the gains are taxed. And they are taxed as ordinary income, not capital gains. If I am under the age of 59 and a half, I have to deal with an additional 10% penalty tax, again on the gains only. Now, what I will also add in respect to modified endowment contracts, extra information here, we always like to do this, is death benefit proceeds are still paid out 100% income tax-free to my beneficiaries. There are times, especially for legacy planning, or if one has a lump sum of money they just want to leave more efficiently, there are times a MEC might make sense. If cash value growth and utilizing my cash value over time is a goal, a MEC usually does not make sense. So how do we get rid of it? Well, any policy can become classified as a MEC. How we prevent it? It's like this. Every policy has what is called a MEC limit, which is exactly what it sounds like. It is a limit that determines the maximum amount of money one can pay into a policy per year and still have the IRS view the policy as a life insurance policy, not a pure taxable investment. So, what many people are not aware of, this is the fun part, is we, or you, the consumer, the policyholder, or us, the agent, can set that MEC limit wherever we want. And how we do it is that it has a direct relationship to an individual's age and total death benefit on a policy. That is, call it the measuring stick that the IRS uses to determine if a life insurance policy will still be viewed as life insurance in their eyes or a pure taxable investment. Now, we do have that new rule coming out, which will adjust the MEC limits. From a MEC limitation standpoint, lesser death benefits will obtain a greater MEC limit than they do today. Guaranteed rates will be adjusted, but the guaranteed values, there's more information to come on that in future videos. All right, so let's get back to this guy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.